Welcome back to Talk Tickers. It is Saturday, January 31st, 2026. If you are tuning in right now, you're probably doing the same thing we are.
Staring at a screen full of red and green, trying to make sense of it all.
Exactly. The earnings barrage from yesterday was a lot.
Yeah.
And the noise-to-signal ratio is just completely out of whack. So today, we are stripping it all down.
Just one ticker.
Just one. The name that usually means safety, dividends, and, let's be honest, maybe a little bit of boredom. We are talking about Franklin Resources, ticker symbol BEN.
Ah, the old guard. But if you still think of them as just your grandfather's mutual fund company, you are missing one of the most interesting pivots happening right now.
That is exactly why we picked them. They reported their Q1 fiscal 26 results yesterday. And I mean, if you just glanced at the headlines on your phone,
You'd think it was a disaster.
a total disaster, a JAP earnings miss, messy accounting. It looked like a major stumble. But then you look at the stock,
It didn't drop.
it rallied. It closed up almost 3% to $26.62.
And the volume was the real tell. 24 million shares. That is some serious institutional money moving around. That isn't just retail traders.
Right. When you see a bad headline and a good stock reaction on that kind of volume, you have to dig in.
There's a disconnect there, a big one.
So that's our mission today. The headline says miss, the tape says buy. We're going to figure out why. We'll unpack the flows, the regulatory news, and this tech story with blockchain that might actually be the most important piece of the whole puzzle.
It's a fascinating setup. Let's get into the numbers.
Okay, snapshot time. Let's just clear the deck on the raw data so we can get to the story. We have to start with EPS, GAAP earnings per share, $0.46.
And the street wanted $0.55. So that's the miss everyone saw.
That's the miss. But then adjusted EPS comes in at $0.70.
A huge beat, a wide margin.
And revenue is $2.81 billion, which also beat by about $360 million. That's up 35% year over year.
Okay, hold on. We have to pause on that GAAP versus adjusted number. I know it sounds like accounting gymnastics.
It always does.
And I'm usually the first to roll my eyes. But for a company like Franklin, which is just constantly acquiring other firms, this distinction is everything.
Because they've been buying everyone, Putnam, Lexington.
Exactly. And when you buy companies of that size, you get these massive non-cash charges. Amortization, integration costs, all this stuff that hammers your official GAAP number, but doesn't really reflect the cash the business is generating right now.
So the smart money just ignores it.
They look right past the GAAP noise in this context. They look at adjusted EPS because that's the proxy for the real cash flow engine.
So the GAAP miss is just an accounting artifact from buying all this growth.
That's it. And the revenue beat tells you the growth they bought is actually sticking. But honestly, even that huge EPS beat isn't why the stock jumped 3%.
No. In this business, earnings are looking in the rearview mirror. The stock price follows one thing.
Flows.
Flows.
Flows are oxygen for an asset manager. If you don't have new money coming in the door, you're slowly dying. And this is where the big surprise was.
Assets under management, or AUM, ended at $1.68 trillion. But the net flows. That was the showstopper.
What was the number?
Long-term net inflows were positive $28 billion for the quarter.
There it is. That's the signal. For years, the story on these traditional managers has just been outflows, outflows, outflows.
The melting ice cube thesis.
Exactly, that everyone's just moving to passive ETFs. So for a legacy firm to post positive $28 billion in long-term net flows, that breaks the entire bearish case. It just shatters it.
I want to drill down on a number inside that because I think it's even more telling. Gross inflows, so just the new money walking in the door, was $118.6 billion.
And that's up 40% from the last quarter.
Up 40% quarter over quarter. What does that tell you about the sales machine?
It tells you the engine isn't broken, it's humming. A 40% jump in gross sales means the distribution teams are out there getting meetings and closing deals. That's not market beta, that's organic growth.
And this all ties back to their big strategy, the one they keep calling One Roof.
It sounds like marketing jargon, but it's actually their core thesis for survival and growth.
The CEO, Jenny Johnson, she explained it pretty clearly.
She did. I mean, think about it from the client side. If you're a giant wealth platform or a sovereign wealth fund, do you want to manage relationships with 50 different little niche managers?
No, of course not. That's a due diligence nightmare. 50 compliance teams, 50 tech stacks.
It's a nightmare. You want to consolidate. You want to shrink that vendor list down to 5 or 6 partners who can do everything. Public, private, fixed income, everything.
So it's the bundle.
Yeah.
It's like the Amazon Prime of asset management.
That's a great way to put it. It is the bundle, and Franklin is positioning themselves to be one of those few survivors with the full menu. We're seeing it work with the Putnam acquisition.
Right. Putnam's performance was driving flows.
In large cap value and
Yeah.
core growth, yeah. And because Franklin owns them, they get to keep that money under their one roof.
So it's not about buying a single fund anymore. It's about buying into the whole Franklin platform.
That is the thesis. And they dropped a little hint about January that I think got the traders really excited.
Oh, yeah, the hot off the press detail. This was important.
They don't usually look forward, but they did.
They said January 2026 is tracking for positive net flows inclusive of Western Asset.
Okay, let's unpack that. That's a really big deal because Western Asset has been the problem child.
We'll get to the regulatory drama in a sec, but just on the numbers, Western has been bleeding assets, a real drag on the whole company.
Right. So for them to say, hey, even with Western's issues, the entire firm is still net flow positive this month, that's a huge confidence signal. It means the other parts of the business are so strong they can carry the weight.
The bleeding has stopped.
Or at least the patient is strong enough that it doesn't matter anymore.
Okay, let's pivot to that other engine you mentioned, the alternatives. Everyone knows fees on plain old mutual funds are going to zero. The real money's in private markets. How's Ben doing there?
This is the second pillar of the whole bull case. They raised $10.8 billion in the quarter for alts.
And of that, $9.5 billion was specifically private markets, right?
Exactly. We're talking private equity, private credit, real estate, the stuff that isn't traded every day on a stock exchange.
And for an asset manager, that capital is sticky.
Very sticky. Your money is locked up for 7, maybe 10 years. That's guaranteed revenue for a decade. It makes the earnings so much higher quality.
And they talked a lot about Lexington Partners.
Lexington is the crown jewel. Their co-investment partner's 6th fund just closed with $4.6 billion. That's a huge haul, but that's not even the real story.
What's the real story?
What's coming next? Lexington is out there right now fundraising for their flagship Fund 11.
This is the big one.
This is the behemoth, and it hasn't even had its first close yet. So think about it. They just posted these great flow numbers without the benefit of their single biggest fundraising event.
So there's more fuel for the fire coming later this year.
It implies these flow numbers could actually accelerate. That's huge.
Okay, we can't put it off any longer. We have to address the elephant in the room, Western Asset and the DOJ. For months, this has been a dark cloud over the stock.
The biggest overhang. The market hates bad news, but it absolutely cannot stand uncertainty. And this was pure uncertainty.
And what did we learn this quarter?
The clouds parted. The Department of Justice declined to pursue criminal charges. They're resolving it through what's called a disposition.
Disposition. Okay, that sounds like a word a lawyer would use. What does it actually mean?
It means a settlement. It means a fine, probably some oversight, but it takes the corporate death penalty off the table. No criminal indictment. That's the key.
So it goes from being this existential crisis to just being a line item expense on the income statement.
Precisely. And that's the relief rally part of yesterday's move. And get this, even with all that drama, Western still generated $6.6 billion in gross sales.
That's the number that shocked me. Who is giving new money to a firm under investigation?
People who care more about performance than headlines. The investment teams are still good. Now that the legal shadow is gone, the sales team can finally go back into meetings and actually talk about investing again.
So Western goes from being a toxic asset to just a turnaround story.
It's a huge shift in sentiment.
Okay, so flows are back, alts are ramping, legal issues are resolved. But I want to talk about the part of the call that I think will matter most 5 years from now.
The technology.
The technology. Usually when a 75-year-old financial firm talks about tech, I tune out. But they dropped some stats that were genuinely wild.
This is the hidden alpha in the story. They're using AI and blockchain to drive margins, not just for a press release.
Let's start with the AI, this intelligence hub. They talk about sales efficiency.
Yeah, the stat was that the time to finalize sales call lists dropped by 90%.
Walk me through what that means for, like, a person at their desk.
Okay, so you're a wholesaler. Your job is to call financial advisors. Before this AI tool, you would spend, say, 3 or 4 hours a week just digging through data to figure out who to call.
This is drudgery.
Total drudgery. The AI does that in 15 minutes now. It just spits out the list and says, call these people, here's why.
And what do they do with all that extra time?
They have more meetings. They said it led to a 9 to 10% increase in actual client interactions. That is pure operating leverage. Same number of people, 10% more sales output.
And then there's the blockchain part. This is where it gets really futuristic. The Benji app.
This is where Jenny Johnson sounds more like a DeFi founder than a mutual fund CEO. The cost comparison they shared was jaw-dropping.
For their transfer agency, right? The back office plumbing.
Yeah, the system that records who owns what. They ran a test, 50,000 transactions.
Okay.
On the old legacy system, that cost them $1.50 per transaction.
So $75,000 seems normal.
Then they ran the same batch on the Stellar blockchain. The cost was not $1.50 per transaction. The cost was $1.13 total.
Wait, stop. You don't mean $1.13 each. You mean for the entire batch of 50,000? The total bill was $1.13?
Yes. The cost reduction is over 99.9%. It's basically free.
How is that even possible?
Because legacy finance is just layers of middlemen checking each other's databases. Blockchain is one shared database. You don't need to pay 3 different people to verify the same trade.
So if you scale that across millions of accounts, the margin expansion is just staggering.
You're taking a massive administrative cost center and taking it to virtually zero. And this leads to their whole vision of tokenized funds.
Right, moving from stablecoins to their money market fund. Why does a corporate treasurer care?
It's the yield. There are hundreds of billions of dollars sitting in stablecoins like USDC right now, earning zero.
Just dead money.
Franklin is saying, why would you hold a stablecoin earning 0% when you can hold our tokenized fund, earn government yield, and still have the instant 247 liquidity of the blockchain?
It's just a better product.
It's a much better product. And all of this, the AI efficiency, the blockchain savings, it all feeds into their margin story.
And management was pretty clear on their margin goals.
Very clear. They're around 25% on adjusted operating margin now. They see a path to the high 20s by the end of this year and over 30% by 2027.
And the CFO said expenses for 2026 should be flat compared to 2025.
Think about that. Revenue is up 35%, AUM is growing, but costs are flat.
That is the definition of operating leverage.
Yeah.
Every new dollar of revenue just drops straight to the bottom line.
It's the payoff for all the integration they've been doing.
And what about more M&A? Are they still shopping?
No, they were very clear. The shop is closed for the mega deals. The transformative phase is over. Now it's just small bolt-ons.
So capital allocation is going to shift from buying companies to just returning cash to shareholders.
Dividends and buybacks. The market loves to see that shift. It's way less risky. It feels like the market is finally seeing the whole picture.
All right. We've covered the fundamentals, flows, tech, margins. Now let's have some fun. It's time for our segment. This is not financial advice.
A standard disclaimer, we're not your advisors. This is for entertainment. Do your own homework.
I have a trade idea for this one. It's a little out there, but I'm calling it the crypto mullet trade.
The crypto mullet trade. I'm almost afraid to ask.
You know the mullet, right? Business in the front, party in the back.
A classic.
The business in the front is Franklin Resources as we know it. A boring, dividend-paying, regulated, old-school asset manager. It's safe. It pays you a decent yield to wait.
Okay, that's the respectable part. Where's the party?
The party is in the back. They are secretly building the rails for the future of finance. We just talked about it. There's $300 billion sitting in stablecoins, earning nothing.
Right, dead money.
Ben is positioning their tokenized money market fund to capture a slice of that. My thesis is if they can convert even 5% of that global stablecoin market.
Because corporate treasurers aren't dumb and they want yield.
Exactly. Then Ben suddenly becomes one of the largest DeFi protocols on the planet, but it's disguised as a boring dividend stock.
I see it. It's a stealth crypto play.
It's a total stealth crypto play. You buy Ben for the safety, but you get a free call option on crypto infrastructure. The trade is you buy Ben and you sell the pure crypto exchanges that just rely on trading fees.
You're betting that yield on the blockchain is a bigger business in the long run than speculation on the blockchain.
That's the trade.
You know, it's a pretty sound thesis. You're betting on the convergence of TradFi and DeFi, and Franklin is one of the only players with a regulated working product already in the market.
And if crypto goes to zero, you still own a great asset manager with a 30% margin target. If crypto takes over the world, you own the plumbing.
The mullet arbitrage. I like it. It's outrageous, but the logic is there.
There you have it. A quarter defined by returning flows, scaling alternatives, and a tech story that is actually hitting the bottom line.
For me, the takeaway is simple. The Gap miss was just noise. The platform they've built is the real signal. Franklin isn't a melting ice cube, it's evolving.
And with that, we're wrapping this deep dive. Keep an eye on those monthly flow numbers. That's the scorecard from here on out. Do your own due diligence, and we will catch you on the next print. Talk Tickers out.